What's up, everyone? What's up, everyone? Hopefully this will be a quick video about how to trade microchannels, kind of going over context, expectations, entry, exit, management, when to scale in, when not to fade, all the good stuff that you can hope for. Hopefully. Let me know if I don't cover everything you want to know, and please leave a comment and let me know what you think. So first of all, I would say most important to define what you mean by 3-bar microchannel or any signal at all. I think you got to have a concrete definition that is repeatable, that you understand, that makes sense to you, and most importantly, is an indication that some event is taking place that matters to you and your system. That's kind of the whole point of having a signal or signal generator. So it must be clear and easy to understand. For example, 3 consecutive bars in the same direction with trending highs or lows. Bad example would be 3 consecutive bars with persistent buying or selling pressure and minimal overlap. And that's a bad example because what is your definition of persistent buying and selling pressure, or the definition of minimal overlap? That could mean a lot of different things. And if you have a loose definition, kind of a loose understanding about those things, then it's going to be hard to repeat that analysis over time. So I would say you got to narrow that down, because maybe persistent means that, for example, the lows can be the same price, or even the one low of a bar could be below a prior low. Does that matter? Does that change the context for your event, for your signal? And minimal overlap, what does that mean? 40% with the prior bar, maybe 20%, and why that amount? Why not 60% or something like that? And ultimately, it's good to remember your goal. The goal is to identify microchannels with a reliable probability of getting a second leg. So for just the sake of, simple repeatable definition, we can just say at least 3 consecutive bars with trending highs or lows. And we have examples of that right here. Maybe the low of the 3rd bar doesn't touch the high of the first bar. That's a really strong microchannel. But even if it does, that's still a pretty strong microchannel. So there's a lot of nuance you could think about with that. And I would suggest to, make a decision about that. And I have a way that you can do that. You can program your own signal generator in TradeStation. And I have a whole video on that. If you want to check it out, I walk through exactly how to program a trading indicator for microchannels, actually, and how to even create like a pullback signal for yourself. And it's in this video called How to Code Price Action for Trading Systems and Research. And that's on my YouTube channel. I posted it last year sometime. So check that out. And that's how you can program your own microchannel signal generator. But let's talk about the microchannel that just happened on Friday. So first of all, you have to accept that signal bars are far less important than the overall context. That means that your microchannel signal, those are signal bars. And that signal is far less important than all of the other context on the chart. You have to be able to objectively read the chart in order to classify that microchannel into a category of, an event, basically. The most important things to consider are, is it occurring in a trend or a trading range? What leg is it? What direction is the current swing direction, the always in direction? We need to know all these things. We have to conduct meaningful research in order to properly classify a microchannel into a category, so then you can figure out how to trade it. And there's a lot of parts of a trade that you just can't know, you just can't do, unless you do the work, unless you figure out a way to repeat your analysis through time. The first part of any trade is going to be the setup. The next part is the signal bars, in this case, a microchannel, right? And I'll just give you the answer. The setup is a breakout, basically. We need a breakout. Expectations for that situation. And your expectations for that situation can only be determined by your research, but the way that you read the market, the way that you understand your signal. Because without that, you can't have expectations. You won't be able to figure out your trader's equation. You won't know where to put your stop or what position size you should be trading. You won't know what your entry options are. They're the best, the optimal entry for this situation. And most importantly, how to manage the trade once you're in it and when to exit. But we're going to go over all of that right now. So how do you calibrate your expectations? Based on the information in this image so far, what do we know? And to answer those questions, you basically have to do your higher time frame analysis. First you need to think about what are the expectations for this month or this week and today, based on yesterday and this week. What does the hourly chart look like? What does the Globex session look like? Just some things to consider. What do the first few bars of the day tell you? What kind of structure and patterns are happening in the opening range? What kind of buying pressure and selling pressure do we have in the opening range? And then, specifically, I wanted to say, think about what happened to the bears who are selling above bar 9. And then another good question to ask yourself is why would anybody sell above bar 9 to begin with? Why is that something you should even think about in the first place? I think if you answer that question, that'll help with clarity about trading in general. Why would somebody do that? And we'll talk about that soon. But anybody that sold that high, they're trapped with bar 10. Bar 10 is a huge surprise. It's clear that we're always in long. We're probably going to go higher, and we did. So all those bears are trapped, and that's going to drive the market higher, creating a second leg. But look at what's happening here with bar 11 and what happened earlier at yesterday's high, this dashed green line. We sold off aggressively from yesterday's high, from bar 4, and we hesitated right here on bar 13. In fact, we closed inside of yesterday's range on bar 11. And that's an important detail to understand. There's a reaction taking place here, and that's important. And then look at what is happening here. We're breaking out above a swing point on a higher time frame, and we're breaking out far enough above it that makes me think we're probably going to go higher. But this is the breakout bar, and look at the breakout bar of the Globex high. Is this a strong breakout above the Globex high, or do the bulls need to do more? This is the breakout bar. What is the follow through going to look like? These are all very important questions to ask yourself, and you can just pause the video, think about it, even rewind it. But I did not mention one bit of, there's not one shred of mention of this being a 3-bar microchannel. That is not part of this analysis whatsoever. I mean, it might be the signal, but that has nothing to do with anything I just said. Everything I just talked about is far more important, the fact that this is a 3-bar microchannel. So that's something to think about. A helpful tool for calibrating your expectations. I like to think about it from this kind of thing that I came up with called the 2+2 perspective. And for me, it's like a system for observing the market objectively, holistically. And the first 2 perspectives go hand in hand. That's why there's 2 plus 2. There's 2 perspectives that go together, plus another 2 perspectives that should go together. Bull perspective and bear perspective. Those always belong side by side. You can't just look at one side. You have to always consider the other side. And then I think it's important to consider the day structure overall. What's the big picture going to look like? And then independently assess within that day structure, what is the immediate price structure that's taking place right now? And, all of that put together is a very holistic way to look at the market. And you may not fully trust yourself unless you understand all of that. So it's very important to understand everything we just talked about so far. Some analysis here for what's going on here. These bears are trapped into a losing trade if they sold above bar 9. So they have to either scale in more at a higher price using a really wide stop, or they have to exit at the market and buy back their shorts. And that's why we have such a strong move up. A lot of those bears started dumping their shorts and buying back their shorts. And that creates this momentum up. We had a strong reversal from bar 4. I just talked about that. So there are likely sellers, more sellers, somewhere above the high of bar 4, somewhere above the high of yesterday. This black line right here is the all-time high close on the daily chart. And the day after that occurred, we had a bear bar, and that created a swing point on a line chart. And that's what this line represents. That's the all-time high close. If you're an institution, you're probably not looking at candle charts. You're probably looking at line charts. And line charts are based on the closes of the bars only. So an institution is going to see a swing point, and that's what this line represents. That's going to attract profit taking. We sold off aggressively here. We may start selling off aggressively up here as well. And this line is the Globex high. There's a lot of statistical research that Ali has done around the Globex session, the Globex range. Most days have some sort of interaction with the Globex price levels, the high and the low. And this to me is a good breakout, but it's barely breaking out. And that tells me that the bulls need to do more, and we may get a pullback before they get more. The bears are clearly trapped down here, but what would happen? What would it look like if today, like most days, were a trading range day? What would take place around these price levels given all of this context? It looks really good for the bulls, but everything I just talked about, is the opposite perspective. We need to consider the strength of the bears, why the market sold off from bar 4, and what could take place around the high close, what could take place around the Globex high, given the information that we know typically happens around those areas. So the immediate context and day structure. Is this part of a trend or a trading range? This is part of a trend. This is what a strong trend looks like. This is a strong breakout. It may be part of a larger overall trading range, but right now, this immediate context, this is trending behavior. And you can argue it's both, but it's at least a small trend within a larger trading range. There's two very strong breakout bars. They're breaking out of a trading range. You need to ask yourself, do I know what a trend day looks like? Do I understand the type of behavior that's typical during the opening range on trending days? And we do have a lot of trading range behavior in this opening range. We have reversals, big tails above and below bars, climactic behavior, disappointing follow through. This breakout failed, reversed up strongly, big climactic bar, not many consecutive bars. That is all trading range behavior. So, that is a lot of great information to understand. And it's possible that maybe this trend is part of some sort of trending trading range day. What leg is it? It's leg 1, but it's possibly leg 2. Why is it leg 1? Because there's no pullbacks. There's no real pullbacks. Bar 11 is a much smaller bar with a big tail above and below it. That is an implied pullback. On a smaller time frame, this is an actual pullback. So therefore, this is leg 1, pause, leg 2. So this is either the third bar of leg 1 or the first bar of leg 2. And there are differences there's similarities and differences for the expectation of what to do in either situation based on your research. You need to do research to understand that. And yes, a trending trading range day is very likely. There's strong pressure on both sides of the market. Bar 10 is an obvious climax. 12 is another obvious climax. That's unsustainable. Trending trading range days have trending behavior in them, but with swings in both directions. And swings last for an hour or so, or sometimes more. So my calibrated expectations for this micro channel, at this moment in time, we're at the all-time high close. I just talked about that. Yesterday was a bear reversal bar, increases the odds of trading range behavior, trading range day structures. The bulls and bears are fairly balanced. Bulls are probably stronger for the moment. Look at the aggressive selling on the open by the bears up until bar 10. That is an important feature of the day. Bears who sold a bar above 9 are trapped. Bar 12 could be all the second leg that the bulls get. But now sellers above the high of bar 4 are trapped with bar 12. That should lead to a small second leg for bar 12 at a minimum. Given all the overlap during the first 9 bars of the day, very likely that more overlap will begin very soon. Likely to pull back near breakout points. We're probably going to go mostly sideways to up for the next several bars. We're breaking out of the Globex high. That could easily fail. But we could trend above the Globex high if we get far enough above it, and if the pullback isn't very strong. There was strong selling above yesterday's high. That increased the odds of more sellers up here. Strong opposite pressure during the opening range. The higher time frames are always in long, and this chart in particular has flipped from long to short to long already. We're at bar 12. The market was long here, flipped to short, flipped back to long, and that's trading range behavior. But we do have trending behavior as well. Then we had a trend up, a trend down, and now we're trending up again. It's trending behavior. So it's likely that we're not going to have a trading range day that's small. It's very likely that we'll have some sort of trending trading range day at a minimum, most likely. And the gaps have closed quickly during the first 9 bars as well. We broke out of the one high, but that gap was closed with bar 4. We broke below the low of the day with bar 9, and that gap closed immediately. We broke below bar 5, and that gap closed immediately on the next bar. So that tells you that these gaps that are created by the close and high of these bars may close soon as well. Now, another part, of my analysis that's important and I think is really something to think about is that not one piece of context that I just discussed mentions anything about the fact that this is a 3-bar microchannel. And that's just another, I just really want to hammer that home, because signal bars are nowhere near as important as the context. And that's all I want to say. I don't want to, keep beating a dead horse. All right, so the entry with the expectation of scaling in during a pullback. So first of all, I want to say you need to do your own homework. And I say that because I don't want to give you all the answers. Because, you really need to figure it out for yourself. And you will. You just work at it. You'll figure it out. And yeah, so how much pullback is statistically likely based on your research, based on your understanding of the market? You need to understand what leg it is, what market state we're in, how many bars are in the setup, the duration of the pullback. I'm really giving you a lot of answers right here, right now. Hint, hint, this is your, research variables. Possible R after entry, what entry is appropriate. For me, my entry options, buy the close, that's one option. It's XTC because you could place the X with, B or S for buy the close, sell the close. I could enter on a small pullback. I could buy below the bar, buy the midpoint of the bar, or buy the buy zone of the bar or the signal range. I could look for a deep pullback, which isn't as ideal. And really, in this situation, a deep pullback would completely change everything. My initial stop for this setup, and this takes research to know, but for me, in this situation, my stop is probably right here. And it may even be right here. And you can say, wow, that's, look at the price scale. That's 50 or 60 points right there. It's a really wide stop. And yeah, it is a really wide stop. But I know what I'm doing. And I would not let that stop get hit if the market were to completely reverse and fail. That's just like the catastrophic stop. And I'm planning to scale in, so I need to use a wide stop. And I understand the risk of doing that. So I've got to be, disciplined and diligent with my actions and behavior. And I need to understand what signs of failure and disappointment look like that tell me when to exit early so that my stop doesn't get hit. And if things do fail, you could think about stopping and reversing your position. But I don't think that's ideal. I don't like to do that. I would say that it takes research to understand when that's appropriate. But yeah, for me, I would expect a pullback probably at least to here at a minimum, maybe further down. You could buy below the bar possibly. And if you get a really deep pullback, this really is not ideal. I wouldn't really want to enter here if I'm already entering up here. If the market pulls back all the way to this point, I would think that this trade is probably going to fail. and it would probably be a good idea to not scale in here and probably think about getting out. But anyway, moving forward. When to fade a microchannel. Well, first of all, I want to tell you, don't fade this microchannel. When you see a strong microchannel, it's probably always in long. You don't want to fade that. You can see the person fading this right here is not going to be happy. Probably, most likely, they're not going to be happy. Frowny face. Fading is an advanced trading skill. You're going to blow your account if you try to fade things before you learn how to trade with trend. And the beautiful thing is, once you understand how to trade with trend, you'll basically automatically understand how to fade things and when to fade them. It's all based on your research. And your research will tell you, what market state, what leg, and, considerations for fading a move. I understand that you see a big move. Is it going to work? Because I want to buy it if it does. If it's not going to work, I want to fade it, right? Because it's going to fail. I get that. I totally get that. I used to think like that too. But a better way to think about it, instead of thinking about it as fading, think about it as, I'm going to enter on the pullback, and I'm going to fade the pullback. It just makes a lot more sense. You can still fade something, but you want to fade the thing that's going to fail. Probably this pullback is going to fail. So you want to fade that. And look at this. It just so happens that the pullback is a 3-bar microchannel. So you get your 3-bar microchannel to fade, and look at this, happy face. You're going to feel good when you fade this 3-bar microchannel. And you don't necessarily even have to think about it as a 3-bar microchannel. It technically is. This last bar is a bull bar. Is that a 3-bar microchannel for you? I mean, does it even matter if you call it a 3-bar microchannel? No, that's an important question to ask, I think. But in any case, you get to fade it. That's great. This move is probably going to fail. You can fade it, but you need to do research to understand when that's appropriate, when it's likely to succeed, and when it's not. There's no other way around it. And this is really important. Here's why you can't fade a strong microchannel when you're starting out. Let's say you fade this microchannel. We have 10, 11, 12. Look at this opening range. This is very similar to this opening range, isn't it? It looks pretty similar, doesn't it? We have a lot of selling pressure right here. We broke out below the low of the day. We got a strong reversal up. Now we're getting late strength in this bull trend right here. Second leg up. Could be a second leg trap. We're breaking out of the Globex range. We got a swing point on a line chart right here. This looks really similar. It's even a Friday. Look at that. It's a Friday. This happened in 2022. We have 3 pushes inside of this micro channel. Maybe you want to fade that. And look at this. We're getting a bear breakout. That's a pretty good breakout. This is probably a breakout pullback short. Reasonable to sell right here. Sell more on a pullback. Similar day structure, opening range. Bears were strong right here. That's likely to show back up later in the day. There's all kinds of reasons to fade this. It's a nested leg 2 move in a trading range, probably some sort of trading range day. Look at all the overlap. Look at all the reversals and tails. It's the failed breakout of the Globex high, this higher time frame swing point. The gaps have closed. The bulls got a gap right here. Look at this. It closed with bar 10. There's a small gap right here between 10 and 12. The bears closed it right there. It's probably a trading range day or something like that, right? Well, how about now? I mean, when you think about this now, should you sell more? I mean, are you fading a trend? And if this is a trend, how come you're not trading with the trend? Why weren't you thinking about buying the pullback over here? You can't just think about the bears side of the market. You got to think about the bulls. For the bulls, they see a wedge bottom or maybe a double bottom with a strong buy signal bar. And they see a tight bull channel. What else they see is a gap on a line chart. The close of bar 1 is a swing point, and the close of bar 14 is a swing point. There's a little gap between those swing points right there. So, and what's the trend direction? At the close of this bar 14, is the market always in long or always in short? And the reason why you would want to fade this is because you just don't know common opening range patterns and structures. You don't know the characteristics of trend days versus trading range days and trending trading range day structures. What does it mean to trade with trend? What is the current swing direction? What amount of opposite pressure is enough to trap the other side? There's a difference between this setup and this one. There's a lot more climactic behavior here. Honestly, I think the bears were a lot stronger than the bulls right here. The bulls are getting really bad follow through here. You can say they're getting bad follow through here, but they really haven't asserted themselves fully yet. And look at them asserting themselves now. And what's happening to the bears? The bears are starting to lose strength right here. And now the bulls are getting more follow through. So I mean, maybe, there's a case for the bears here that's reasonable. But at some point you got to realize, bar 15, you should probably just close the trade, just buy back your shorts, just stop and reverse. I mean, at that point, you got to look at this chart and say, this is potentially a strong trend day. This is actually what a trend day looks like. It does have strong opposite pressure. There are tails above and below bars. There is overlap. There is bad follow through for the with trend side. But at some point, you look back and see, oh my gosh, there's a gap and there's a good gap here. And this is actually a spike. And this is the first pullback and it's failing. And now look at this. This is a new spike. This is resetting the market cycle. So it can still fail. I mean, you look at this. We're getting sideways price action here. This could fail. This could be, 3 pushes up, a wedge top. But, the reality is it's more likely the market is going to keep doing what it's been doing. Trends have inertia. It takes a lot of energy to slow them down and reverse them. And if you keep trying to fade micro channels that look strong, that could be climactic, that could be part of a trading range day or trending trading range day, you're going to blow your account. It's not going to work. You have to be able to understand how to trade with the trend first. Then you can start thinking about fading things. If anything, you should be fading these pullbacks. Look at this, frowny face. Again, frowny face. You can't be fading strong trends. You're going to get a frowny face. You got to realize that researching and building systems and committing to practicing your craft is the only way to become a successful day trader. And sometimes you just have to do the wrong thing enough times before you realize, oh my gosh, I really need to stop doing this. I got to figure out how to mitigate, stop myself from doing this. You got to trade with the trend, all right? You got to fade the pullback. Look at all these happy faces. Smiley face, smiley face. Yeah, once you do the wrong thing enough times, you figure out, okay, I got to get with the program. When you know what's happening, when you know what to expect, and when you're trading with the trend, you feel happy, you feel good. You're doing the right thing. And look how many opportunities there are to trade. You can buy that pullback. You can buy below 12. You can buy the close of 14. You can buy the close of 15. And you can scalp out within a bar or two. You can buy a small pullback into 16, or you could buy below a bad sell signal. You can buy a test of the close of 15. Why is the close of 15 support right here? That's a good question to think about. You can buy the close here. You can buy a pullback there. You can scalp out. There's a lot of opportunities to trade with the trend. But anyways, let's get back to Friday, this past Friday. All right, so at this moment, this is what's possible. We have several measured move targets above. We could get a measured move of the whole opening range. We could get a measured move of the opening range based on a line chart, which would be the close of 9 to the close of 3. We could get a measured move of 10. We could get a measured move of this whole micro channel. There's a lot of targets above there. 60% chance we're going to get to at least a couple of those targets, maybe even all of them. I mean, that's possible. It's possible. But this completely changes everything. First of all, we're getting a strong bear reversal bar at resistance, and we're getting strong follow through as well. These are trend bars. We're getting trend bars against a trend, and it's happening at an obvious place of resistance. And remember all the context we just discussed earlier about the high close and the Globex high and what happened with sellers above 4. If you sold above 4, sold more higher, you actually made a profit on all of your trades. And if you sold below 13, you made a scalp. So to me, that completely changes everything. That tells me that we are not in a strong bull trend. This possibly is not a strong trend day. It is very likely the market is probably going to go sideways. So the follow through after bar 14 is really important. And yeah, most importantly, it tells you that we're probably not going to reach this target. We're probably not going to reach that target. But, these targets are relatively close. If we pull back and get some good momentum, we could get to these targets. We'll see. We have to look at the follow through. But that's when the probabilities change. You need to recalibrate your expectations when you get a big surprise against your position or against your thesis. If you're not in the market, if you're not long at the close of 14, it might be a good idea to just wait another bar or two before you decide whether or not to get long, because it's possible this trade could fail. So anyway, to recalibrate yourself, just ask yourself, is 13-14 going to get a second leg? Is this a major or minor reversal? What is this going to do to the day structure? And you have to study day structure to understand what it's probably going to do. How trapped are the bears still? Are they trapped? What's possible to unfold here? It's possible we get a huge acceleration bar on bar 15 and we run to a new low of the day in one bar. That is absolutely possible. It's also possible that some institution is going to buy the close, buy the shit out of bar 14, and we're going to rally to the highest measured move target on the chart in one bar. That's possible too. But you got to look at a lot of charts to understand how likely either of those things are and what's a reasonable possibility to expect. And basically you just, you got to ask yourself, am I completely fucked? If I enter, I bought the close of 12, scaled in on a pullback, am I totally fucked? And the only way to know if you're completely screwed is to do the work. You have to do the research. But okay, reeling it back to the analysis. Remember, we anticipated a pullback. This is what it looks like when you enter on a pullback. A pullback is by definition a move against the trend. And that is what we're looking at on our chart. It's still possible we can reach the measured move targets, but the bulls need to do more, and they need to do more right now or very soon. Otherwise, this trade is going to fail and we need to get out. So here's some follow through, and here's some more thoughts. So we got a bull bar in bar 15, and we got another bull bar in 16. So for me, I'm long. I'm feeling okay. I think that it's possible 13 and 14 is a stronger surprise than what I would like, but I think it's reasonable to hold. We've got a couple of bull bars on the chart, and we're starting to get some pullbacks, and we're starting to channel higher. But this is not what I expected. This is not a strong bull trend. This looks like a spike and a weak channel up. What happened to all the strong momentum that the bulls had with 10 and 12? Where is that? It's not here. It's not happening. And also look at how strong the bears are. The bears are creating reversals, deep pullbacks after these strong bull bars on 16 and 18. And now, by the close of bar 20, we have a parabolic wedge pullback. We have leg 3. 1, 2, 3. So there's a risk of a wedge top and a double top near the high close and the trend high on 12 and 13. So it's possible that the bears may be able to get a major reversal up here. So this changes everything. We need to get out of this trade as soon as possible. There's way too much risk of a major reversal up here around the high close of bar 12. That's the last place that the bulls were buying very aggressively. And if you bought the close of 12, sat through all this, you're stuck. And you're seeing this and you're thinking, it's probably not going to go a lot higher. I should probably just scale in and then get out in this area. So for me, I'm moving my profit-taking limit order away from those measured move targets, and I'm putting it at a minimum right here at the trend high, and probably I'm going to get out right here at the high close, because this is too much selling pressure along with this selling pressure to make me think that we're going to get that, we may not even get a new high up here. And look at these pullbacks after 16 and 18. What do you think is going to happen after bar 20? So we need to get out of this trade pretty quickly. This changes everything. This completely changed the thesis we had at the time of the close of bar 12. So it's no longer a strong bull trend. It's unlikely to be a bull trend day. It's still probably some sort of trending trading range day structure, but now the possibility of having a reversal day, that probability has risen. And we could have more severe trading range behavior at a minimum due to the increasing opposite pressure, as demonstrated by 13-14 and demonstrated on 17 and 19. The energy of the market is not that of a trend day, but you would only know that if you looked at a lot of charts that are trend days. So you got to understand what that market energy looks like. You have to look at a lot of trends. You got to look at a lot of trading ranges. So the resulting day structure here was, in fact, a trending trading range day. We had a swing up, we had a swing down, we had another swing up. You could say it was a trending trading range bull trend, and you would be correct. But in my mind, probably half of the day was spent building a bear swing. So I would not call it a bull trending trading range day. I'd be more inclined to call it a trending trading range day. So the most helpful tips I can give you would be to collect 1,000 charts and name everything that's taking place on the chart. I have a video on that. It's called How to Build Your Own Chart Archive or something like that. And I would say you should really target 4 years of charts. That's 1,000 charts at minimum. Ideally, you double it or quadruple it. That would be 8 to 16 years of charts. If you really want to master day trading, if you really want to be able to trade all day, if you want to be like Al Brooks, if you want to understand what's happening on every bar, every tick, you need to look at thousands of charts, and it's going to take a long, long time. Anyway, yeah, level 1 research, that's basic signal response research. I made a video on that the other day. Start a project and just open up an Excel document, put a few columns in for trend or trading range, leg count, and was there a tradable second leg or not? And just start doing some research, just piece it together. You can figure it out. It is not rocket science. You can figure it out. I've got a video on that too. I think I posted the other day. And then practice bar by bar reviews, because probably the best trader I know, I talked to a few weeks ago, told me that 20% of successful trading is made up of statistical research, and that's required. We have to do it. We have to understand it. It's required, but it's only 20% of the picture. 80% of being a successful trader is bar by bar analysis and context analysis in real time. You have to do both, but understanding the context and analyzing the bars one at a time is most of the work. That's most of the success in trading. So anyway, that's been the video. Please like, subscribe, leave me your comment. Let me know how you liked it. Hope you enjoyed it. It's a really long video. I'm sorry about that. I'll try to keep it shorter in the future. I appreciate your time. Let me know how you're doing. And thanks. Take care. Love you. Bye.